Muyiwa, I see the Intercontinental and Access Bank deal has been approved. Now, just listening to commentary from the CEO there, he's saying that net interest margins he expects are going to improve quite dramatically. What is your take on the tie-up between these two?
I think my take is that it would obviously be earnings accretive in the medium to longer term, but we think in the immediate term it might still be earnings dilutive because the combination of the two banks would still incur some integration costs, and that, in my view, would still drive down earnings in the immediate term. But we think as the bank emerges and migrates and integrates the two businesses further, we feel that would result in an earnings accretive business. And we also think that, like as the bank's MD highlighted, cost of funds would reduce significantly given the huge deposit base of Intercontinental Bank and its cheap deposit base as well. And we feel that would increase Access Bank's net interest margins in the medium term and help it to compare favorably with the Tier 1 banks that have access to relatively cheap funding, and so that helps them to compete better in the corporate space.
How would margins for the likes of the Access and Intercontinental tie-up compare to the other two, that being, of course, FCMB Finbank and ETI Oceanic, if these two mergers are approved?
I think if the mergers are approved, we expect Access and Intercontinental's net interest margins to still come up stronger, because if you look at the balance sheet of Finbank and FCMB, it's still significantly smaller. Even though it still has a relatively wide branch spread, but I think in terms of growing retail deposits significantly, we think that Intercontinental and Access, the tie, has potential of growing stronger cheap retail deposits. And I think even looking at Access Bank and FCMB on a standalone basis, Access Bank still compares significantly better and performs significantly better than FCMB in terms of net interest margins. As at H1 2011, Access Bank's net interest margins stood at 8.2%, while FCMB's, even though it had improved significantly, it improved to over 6%, but it's still lower than Access Bank's net interest margins.
Yep. Looking at a capital adequacy of the banks, if these three mergers are approved going forward, what type of capital adequacy levels will we be sitting at for the three mergers?
For the three mergers, looking at them, capital adequacy ratio would still sit above the regulatory requirement, which is 10%, and even in our view, we feel it will still sit above the sector comfort level, which is 15% as well. I think for EcoBank and Oceanic, net capital adequacy ratio would be at, I think, at 19%. That's the estimate. For Intercontinental and Access Bank, it would be over 20%, and also for FCNB and Finbank as well, to be over 20%. But we feel in the medium to longer term, as these banks try to drive risk assets and grow their loan books, in par with the sector average, we feel that there might still be some pressure on capital adequacy ratios at that point. And so over the next after 18 months, we expect these banks to come to the market to try to raise capital at that point in time. And it could be a form of equity or debt.
Or debt, okay.
We think it could either be in any form, but I think I would expect it to be in debt form at this point, because most of them already have bond programs already in place that has been approved by shareholders. So I think it's really just trying to draw down that, and I think that might be the likely scenario at this once the capital is needed.
Which bank, which of the three types do you see having the best cost-to-income ratio post-merger?
I think at this point it might still be too early to tell, because a combination of these banks still put them at operating losses. And so even though we feel that, in our view, we feel that first FCMB and Finbank would integrate faster given the relatively smaller size, and so we might see cost-to-income ratio reduce for this combination in much faster than we might see with ETI and Oceanic or Access Bank and Intercontinental. But I think in the medium to longer term, as these banks integrate further, then we might see Access Bank and Intercontinental Bank standing in a strong position. And I think they have the likelihood of, given their relatively larger size and cheap funding base, they would be able to compete better and have stronger margins than the other two.
So Access Intercontinental, of course, moves into Tier 1 space, would become the #3 bank by assets in Nigeria. FCMB FinBank would move to the top of Tier 2 space. But of the three entities, which do you see posing the biggest threat to the top tier banks as they stand at this point?
I think, in my view, I feel in the immediate term, all the three won't have we don't think they would pose a threat, because they would be larger banks, but we still think because they'll be busy with integration issues, they might not necessarily, they'll be distracted with integration issues, and so would be less of a threat now. But we think in the medium term, as these banks integrate fully, we think that Access Bank and Intercontinental pose the largest threat. And I think one major reason why I have that view is that it has a very strong and dynamic, aggressive management team, which I think other banks would look out for. And so we think that they would compete more in the corporate space and would really give the Tier 1 banks a run for their money in that space as well, given their cheaper funding base.
Muyiwa, we've still got EGMs for the likes of the other two banks, FCMB, FinBank, and ETI and Oceanic. Do you see any threats or risks that shareholders won't approve these deals?
I think that in my view, I don't think we can rule out that risk at this point until the deals are approved by the various shareholders. Because, I think one major reason why we have that belief is because of the fact that the MD of AMCON still stated last week that it's ready to recapitalize any of the banks that don't meet approval. And I think there will also be some shareholders that might not necessarily be happy with the CBN reform process at this point, and so might want to try to obstruct the process. But in terms of gathering support from shareholders, I think that risk is limited. But we think that risk is still there, and so until we see all these deals are approved, there's still the potential risk that shareholders might not approve, and we might see some nationalization. But I think the risk is very limited, but it's still there until the deals are approved.